Discover a bunch of great investment options using mutual funds, an easy and effective way to grow your money. With mutual funds, many people pool their money together and experts handle the investments. It's like having a mix of different investments that help spread out risk. Whether you're new to investing or have some experience, mutual funds make it simple to have a diverse portfolio without needing to be a market expert. In this video, I'll explain mutual funds and provide essential information on how to invest them, catering to both common individuals and beginner investors. Let's get started. When you receive your monthly salary, it's wise to set aside some money for future needs or emergencies. While stashing cash in a bank is a common practice, it's not the best option due to inflation gradually reducing its value by 4 to 5% annually. To address this, people often explore various investment avenues. In this country, there are 4 primary options. Number 1. Savings account. Number 2. Fixed deposit or FD. Number 3. Gold or jewelry. And number 4. Real estate. Some individuals with a higher risk tolerance might also consider investing in the stock market to avoid the devaluation of their funds over time. Investments involve 3 crucial factors: return, risk, and time. Return represents the percentage of profit earned from the investment, factoring in the need to outpace inflation for genuine growth. Risk evaluates the likelihood of capital loss and financial setbacks. And time refers to the duration of the investment. In general, higher returns are associated with greater risks and longer investment periods. To achieve higher returns, one must be willing to take on more risk and commit to longer-term investments. Savings accounts, offering minimal risk and easy access, provide low returns, typically around 4%, often failing to beat inflation rates. Fixed deposits provide a less risky alternative with a fixed time commitment, resulting in slightly higher returns, typically in the range of 7 to 8%. Gold and jewelry carry significant risks nowadays due to price fluctuations. If you examine their history, you'll find that until 2012, prices consistently rose. Investing before 2012 would have yielded a good return. However, since then, there have been ups and downs, with prices leveling off leading to less profit. Property investment involves moderate risk with fluctuating returns, especially in India's housing market. While it can yield high returns, it demands substantial capital. On the other hand, the stock market presents the potential for high returns, but the risk depends on stock selection, requiring a good understanding of market dynamics to mitigate losses. Now, those were some of the main types of investments I shared with you. However, there are others, like government bonds, corporate bonds, and even cryptocurrency such as bitcoins. A common and sound piece of advice is never to put all your money in one place. Instead, spread your investments across different areas to avoid a total loss in case of a market crash. While the simultaneous crash of gold, properties, and the stock market is rare, it's better to be safe. This strategy is known as diversification, where you invest in different places. Mutual funds offer a unique way to achieve this diversification. These funds are created and managed by asset management companies or AMCs. You give your money to an AMC and they pull it with money from others. The company's experts then invest this collective pool in various places based on their recommendations. The return generated is used by the AMC, which keeps a small percentage, usually 1 to 2% as profit, and the rest is returned to you based on your share of the investment. Companies and banks like HDFC, HSBC, ICICI, Aditya Birla, Reliance, and TATA have their own asset management companies, and they launch various mutual funds. For instance, ICICI has more than 1,200 mutual funds. The risk and return of your mutual funds depend on the specific funds you choose to invest in. Mutual funds can offer returns ranging from 4% to over 30%, and they can either be low or high risk, depending on where the asset management company invests your money in. If the company invests in stocks, it's riskier but may yield higher returns. If it's government bonds, it's less risky. The different types of mutual funds are categorized into 3 main groups: equity mutual funds, debt mutual funds, and hybrid mutual funds. Now, turning the attention to equity mutual funds, these funds involve investing your money in the stock market. But before I talk about that more, don't forget to like, subscribe, and hit the notification bell for more insightful content. Naturally, this type of mutual fund tends to have more risk, but offers higher potential returns. In the stock market, the risk and return depend on the type of company you invest in. If it's a large company, it falls into the category of large cap equity funds. If it's a small company, it's termed as small cap, and there are also mid cap equity funds for those in between. Large companies typically have lower risk but may not grow as fast. Both the risk and return are generally lower in large companies. Investments are spread across large, medium, and small caps or different companies. Moving on to equity-linked saving schemes or ELSS, this is a special type of equity fund designed to offer tax savings. These funds invest in companies within sectors like agriculture, logistics, or transport. For example, UTI Transportation and Logistics Fund fall into this category. ELSS funds can be riskier because all the investment is concentrated in one sector. So if that sector declines, the fund's performance depends on it. Another type of equity fund is the index fund. These are passively managed funds, meaning no AMC agent decides where to invest the money. They track market rates, moving up and down based on the prices of Sensex and Nifty. Shifting the focus to the second category of mutual funds, debt mutual funds involve investments in debt instruments like bonds, debentures, and certificates of deposit. Let's talk about liquid funds within this category. Liquid funds are mutual funds that can be easily and quickly converted into cash, reflecting their low risk. They can be likened to an alternative to a savings account. An example is the Asset Liquid Fund, which offers a return of 7.1% in a year. The consistent growth shown in the graph over the last 5 years indicates a relatively low level of risk associated with these funds. Now, when it comes to debt mutual funds, the interest rates can often fluctuate. Another type worth mentioning is fixed maturity plans or FMPs, which can be seen as an alternative to fixed deposits or FDs. They carry very low risk, similar to FDs, and are designed for a fixed period. The investment is committed for a specific duration, and you can't withdraw the money before that time. These are just a few examples of debt funds. There are more, such as the junk bond scheme. Moving on to the third category of mutual funds, I have hybrid mutual funds. Essentially, these funds are a blend of both debt and equity mutual funds. They cater to individuals who want to invest in the stock market but prefer not to put all their money there, opting to allocate some amount to debt instruments. For instance, in a balanced savings fund, approximately 70% of your money is invested in low-risk debt funds, and the remaining 30% is in equity funds. On the flip side, if 70% is in high-risk equity funds, it's termed as a balanced advantage fund. Hybrid mutual funds also include various types like arbitrage funds. Mutual funds offer a significant advantage over other investments because they provide built-in diversification. This means that your risk is minimized because your money is spread across various assets. Unlike putting all your money in one place, where a downturn could heavily impact your investment, mutual funds spread the risk. Compared to investments like stocks, gold, or real estate, mutual funds are generally considered less risky. However, the level of risk can vary depending on the specific mutual fund you choose. Another benefit is the accessibility of mutual funds. You don't need a large lump sum to invest. You can opt for a systematic investment plan, or SIP, and contribute a small amount every month. Additionally, mutual funds are managed by professionals or fund managers who make investment decisions on your behalf, eliminating the need for you to actively manage your investments. On the flip side, mutual funds have their drawbacks. Entrusting your money to an unfamiliar fund manager comes with uncertainty about how well they will perform. Even though they are experts, there's no guarantee that they will always make the right decision. Historically, a significant disadvantage of mutual funds was the high commissions charged by agents for handling your investments. I hope you found valuable insights that empower you on your investment journey. Now it's your turn. Do you currently invest in mutual funds? And if so, what has been your experience? Are there specific topics you'd like for me to delve into in future videos? Share your thoughts in the comments below. But remember, investing in anything like mutual funds always generates a passive income stream. But before you invest, you need money that will come from your active income. The more high-paying it is, the better. But how would you know which are the best ways to earn a minimum of $10,000 each month? I have already made a video to give that guidance on the best ways to make $10,000 per month in 2024. Don't miss that one.